While markets go up and down from year to year, it can be much scarier to go through a market sell-off during the retirement years if you do not have the right investment strategy, because if all of a sudden you see your entire retirement savings drop by 20, 30, 40% and you're drawing down on those assets, it might not recover like it used to during your accumulation year. So in this video today, we're going to be covering some of the investment strategies we use with our clients once they've entered the retirement years. Hello everyone, I am Michael Roker. I am the managing partner of Greenbush Financial Group. Some of the investment strategies we're going to be discussing today for retirees revolve around a few concepts. So number one is understanding the difference between the accumulation years and the distribution years from an investment strategy standpoint. Number two, why market downturns can be so damaging in the retirement years. Number three, the irreversible mistake that retirees need to avoid. Number four, the risk of holding concentrated positions in retirement. And number five, why actually being too conservative in retirement can also be a risk. The first concept we're going to cover is understanding investment strategy in the accumulation years versus what we call the distribution years of retirement. So during the accumulation years, you're adding money to the accounts. You're not taking any money out for distribution. So when the markets go up and down, when you experience a downturn, oftentimes those account balances bounce back very quickly versus when you enter the distribution years of retirement. Now, when there's a market downturn, you may be taking withdrawals from that account to supplement your income. So you're forced to sell at lows so the balance doesn't bounce back like it used to during the accumulation years. Because this risk exists, retirees will often prudently take a step back and risk when they retire within their investment portfolio. If they were very aggressive during the accumulation years, let's say they were 90 or 100% in stock, depending on their distribution plan, they may decide to step back to, let's say, 50, 60, or 70% in stock as soon as they approach their retirement date. And this is all to avoid what we call the irreversible mistake, which retirees that stay aggressive too long, a lot of times if they've had really great gains in the markets for a number of years, it's tough to accept potentially a lower rate of return by becoming more conservative. They stay aggressive and all of a sudden there's a massive market downturn. And now that they're retired, they can't continue to stay aggressive to wait for the market to come back because they're already drawing down on assets. And once the money's gone, it's gone. So then the next natural question is, how much should I step back and risk as I enter retirement within my portfolio? And this answer does vary greatly person to person because it all depends on how much you need to draw off of your retirement accounts in the retirement years and also the makeup of your accounts. So we could have a client that, let's say, has a Roth IRA, a traditional IRA, and a brokerage account. If they never plan on touching that Roth IRA in the retirement years to meet income needs, they might purposely want to stay very aggressive in that account versus if they plan to draw off the traditional IRA and the brokerage account to meet income needs, those accounts might warrant a step down in risk because now market volatility is going to have a greater impact on those accounts now that we've entered the distribution phase. The third investment risk for individuals ending retirement is what we call a concentrated position. So it's not uncommon for two reasons that individuals might have one individual investment holding that represents a very large portion of their overall assets. The first scenario is when someone worked for a public company and they had that company stock in their 401k via options, via employee stock purchase programs, and look at their overall holdings and say, wow, that is 60% plus of my total investment holdings going to retirement. While they may have been able to weather those risks during the accumulation years, it represents an even greater risk in retirement because now if they have to draw down on assets and that single company drops by 50%, that is another irreversible mistake. And the second scenario is someone purchased a stock over the last 5 or 10 years that did extremely well, and now that single position represents 30% or more of their overall portfolio. Sometimes those holdings are even more difficult to sell than the employer's stock because of what we call teddy bear syndrome. This stock has obviously done very well for these clients. It's created a lot of wealth and it's very tough for them to sell it. So sometimes they'll enter the retirement year saying, I just can't sell it. And then that company experiences a big downturn. Again, another irreversible mistake. Managing the risk of these concentrated positions does not necessarily mean you have to sell the entire holding, but it's more of a plan to say, what steps are you going to take to slowly reduce that risk by potentially selling pieces of that holding also take into account the tax impact if it's held within a taxable account to get your risk in line for the retirement years. Up until now, we've been talking about all the strategies needed to reduce risk for the retirement years, but there is a big risk in the retirement years of actually being too conservative. Sometimes people will go from a complete growth portfolio, they retire, and then they throw it all in CDs and bonds, but there's two major risks for that. One is longevity risk, you're going to outlive your retirement savings, and two is inflation risk. Because individuals are retiring in their 60s and now living into their 80s and 90s, those retirement assets have to last longer and continue to hedge the negative impacts of inflation because if the price of everything is going up by 3-4% per year and your assets are not performing at least at the level of inflation, a few years down the road, you're going to feel like you're losing ground. Maybe your after-tax expenses started at $60,000 a year, but then 15 years from now, it might cost you 90 or 100 grand just to purchase those same goods and services. So as retirees consider the changes they may want to make to their investment portfolio as they approach retirement, it isn't necessarily about elimination of risk. It's about management of risk, knowing you're going from accumulation to distribution phase. You obviously want to avoid all those irreversible mistakes that we talked about. If you have concentrated positions, what's the strategy for managing the risks around those concentrated positions while at the same time making sure not being too conservative that you could outlive your assets. I hope all this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.